morning and welcome to On the Money right here on WDBO AM, rather, 580, or always streaming inside your WDBO app. If you want to join the conversation, we got some open lines -1 because Kim was fast on the dial. Kim knows what this hour is. Kim loves taking advantage of this hour because we have live financial call-in advice brought to you by Certified Financial Group here in Central Florida. Let me give the number real fast if you want to hop in line, 844-580-9322. I'm going to start that one over as well. 844. You can take over, Aaron, if you want.
You got it.
844-580-9326, or send in your open mic using the free WDBO app. Aaron, Rodney, how are we doing today?
We are doing great. How you doing, Josh?
I'm getting out of here as fast as I can. It's your show now.
I appreciate that. Rodney and I are here to answer financial questions. Anything on your financial mind having to do with personal finances. So, we always like to say Monday through Friday, we meet with clients and we talk about their personal financial situation, whether it's retirement, Social Security, portfolio allocations, annuities, long-term health care, I don't know, all that and more. Actually, we talk about that Monday through Friday with clients, and Saturday mornings, we give up an hour of our time to come here and answer questions for clients just like Kim, who is on the line. And the idea is that we're providing advice out to you so that you can make smart financial decisions, become interested in our company, and possibly, maybe go to one of our workshops or want to schedule an appointment with one of our planners or come in and talk to us, or, just call in on Saturday morning and fill up our phone lines so that we have something to talk about, so Rodney and I aren't just looking at each other for the next 60 minutes. So but I see that the phones are filling up, so why don't we get it kicked off with Kim, and then after that we can maybe go to the topic of the day. So
of course, again, if you want to call in, 844-580-9326, 844-580-WDBO. Kim is calling from Mount Dora. Go ahead, Kim. You're on the air.
Hi, good morning.
Hey, good morning, Kim. Thanks for calling.
You're welcome. I was just wondering about a recommendation for some of my IRA, my traditional IRA profits or gains that have been made this year.
Sure.
I'm 65 and retired. I have other good income sources right now.
Okay.
And so I don't really want to be taking that gain out and getting taxed on it as ordinary income, or even converting it over to a Roth, because it's going to jump up my tax brackets quite a bit.
Right.
So I was thinking about converting the gains off of my profits into either an IRA MIGA or an IRA CD. I don't really want to leave it in the market and risk losing that profit right now, because I may need to start using that gain or that money in just a couple years. I don't have that 7-year time frame out.
Sure.
So I'm just, I'm not really sure what to do about the gains on that traditional IRA, which was my 401k, and I rolled it over.
Got it. Understood.
Yeah.
What do you think, Rodney?
So she's ramping down, kind of like a target date fund, right? Sounds like.
Yeah, I mean, she's retired. She has money in her plan, and really, it's more of how much return do I need in order to do the things that I want to do,
and reducing the risk in the allocation.
Right. That's basically, Kim, what you're asking is should I get more conservative now with the money that I have, and is that going to be sufficient for me for the next 30 years through my retirement years? Right?
Yes, that is correct.
Yeah, and really that comes down to knowing what your overall financial situation is, and everybody is different. So you're talking about a MIGA, which is a multi-year guaranteed annuity, which basically allows you to it's like a CD but offered by an insurance company, and so it's a fixed rate annuity that will pay a guaranteed rate for a period of time. Or CDs, as everyone knows, is issued by banks, also paying a fixed rate of return for a period of time. But in your particular situation, Kim, that's hard to say because it really depends on what your other assets are, what kind of cash flow you have, what your needs are for the long run. But really, this is kind of what we do on a day-to-day basis with retirement planning for clients. But you're in the decumulation stage, right? So we're trying to figure out how to effectively decumulate your money to keep you in the tax bracket that you want to be in, and effectively and efficiently make sure that you're diversified enough to get the returns that you need so that you continue to keep pace with inflation and be able to do all the things that you want to do. It's really hard to say whether or not it's possible for you to do that, or whether you should do it. I mean, obviously you can do it, but whether you should do it without really doing an in-depth financial plan for you and really seeing what your needs are going forward. You got any thoughts, Rodney?
At a high level, I mean, I like what she's thinking, but you're right. I mean, sometimes the devil's in the details, right? But at a very high level, I like that. I mean, if you look at some of the MIGAs out there, they're well over 5%. In terms of the yield,
Yeah.
which is a lot higher than you're getting.
Well, and they're creeping down too with the interest rate cuts that just happened. So they are starting to come down a little bit, but at 5%, you're probably locking it up for 5 or 6 years, right?
Right.
At that kind of rate.
Yep.
Which you will get a better rate with a multi-year guaranteed annuity than you generally would with a CD or a Treasury. But but you are locking it up with an insurance company. But again, Kim, I really think you're a perfect planning opportunity to really dig in and do that kind of analysis. But it's really hard to say whether or not you should do that based off the information that you gave us.
And really, the question comes down to she's replacing the fixed income allocation to some extent, right, with the MIGA,
yeah,
potentially.
Possibly.
So really, the catch is determining what that percentage is, because we know there should be some allocation to fixed income.
Well, right, and it depends on, are you 100% in equities right now? Are you taking the profits off the equities and then putting it into the fixed income? Are you just taking the overall gain that you had, selling off equities and fixed income to buy more fixed income, which is effectively making you more conservative?
Right.
What is that doing to your overall portfolio allocation? And what sort of rate of return or allocation do you need in order to keep living your life you want to live for the next, like I said, 30 years? So, Kim, I suggest... I know it's not, again, we can't really give an in-depth analysis with the limited information we have, but we'd love to talk to you if you want to give us a call on Monday, talk with one of our planners, and maybe put together a complete financial analysis for you so we can greatly answer your question and definitely give you better guidance going forward.
Okay, great. Thank you very much.
All right, I appreciate the call. Thank you.
Thanks, Kim.
And I see the phone lines are filling up, Josh. We just want to roll?
Yeah, let's keep on going. You want to go to Alberto. Alberto's got a question about what separates Certified Financial Group. Go ahead, Alberto. You're on the air.
Yes, good morning, and thank you for taking my call. I'm just, at this point, I'm 68, and I just want to check around and see what is being offered. And I was asking to your, the person on the call,
Sure.
what is the difference between your services and Fidelity or Schwab, which I've already looked into, but I want to know what you offer compared to them.
Sure. I think the biggest differentiator that we are is that we're independent, which means that, Fidelity and Schwab have their own house products that they have within their arsenals. So there's a lot of Fidelity funds out there. There's Schwab funds out there. A lot of people, if you go to Fidelity and Schwab, are going to end up with Fidelity and Schwab funds within their portfolio. The funny thing is we actually use Fidelity and Schwab as our custodians, which means that any client that we work with, their money ends up at Fidelity or Schwab. But we're using their institutional platform, which allows us to be the advisor on their platform and make decisions and help you, guide you using the Fidelity and Schwab platforms. The other thing with Fidelity and Schwab, from my experience, from what I've seen, is that those advisors generally have huge books of business, meaning they're dealing with thousands and thousands of customers, especially if you're dealing with the retail branches, which means that you are just, one person among thousands that's probably not going to get the attention and service that you may or want, may need or want. But any other thoughts about major differences?
No, I just think to your point, Aaron, the diversity of funds we choose from the entire universe of available investments, and aren't beholden to any particular house products.
Yeah, and we do see that a lot when clients come over from Schwab or Fidelity with those types of portfolios with the advisors that they're using, that they do have a lot of the house products in their portfolios. And I will be honest, we do use some of the Fidelity and Schwab funds, but you're not exclusively locked into those particular investments, and that's part of being an independent firm, and that's part of what we've been doing for the last 40 years is making sure that our independence is known and that we're not beholden to one particular fund company or another because, it pays us more money. The only fees that we collect from our clients is from our clients and not from any of the mutual funds or investments or ETFs or anything that we recommend when we're building out portfolios. The other thing I think we also we do better than them is that is on the financial planning process.
Right.
I don't think
It's much more thorough.
Yeah, they don't get very in depth with the financial planning process, and so I think our process is more thorough, and our service I feel is superior. One thing we always talk about is when you call us, you don't get a 1-800 number, or you're not calling a 1-800 number, and you're not getting an answering machine. You're talking to a real person who always answers the phone, and you're generally going to talk to the planner that you've been working with since you started, or their assistant, because we do have some assistants obviously that work here as well. So I think that kind of outlines the major differences. Does that kind of answer your question? Do you have any other follow-ups, Alberto?
I just want to follow up on that. So does that mean that your fees are pretty much similar, or are they different, or lower, or compared to what they charge?
I don't know Fidelity and Schwab's exact fee schedule, because a lot of it has to deal with assets under management and size of portfolio and services being offered. So I can't really opine on fees. Generally, the fees within our industry are all pretty similar, though. But again, you have to feel like you're getting value for the fees that are being paid. So if you get zero service, but you're paying a fee, you're probably not feeling like you're getting much value. Conversely, if you're paying a fee, you get great service, you probably feel like the value is great. So I can't really opine on the particular offering from either of those companies in comparison to ours.
But they are comparable, to your point earlier, across the industry.
Thank you so much.
Yes, sir. Hopefully it helps you out. Appreciate the call, Alberto.
Thanks, Alberto.
Thank you.
Go ahead.
No, go ahead, John.
Thank you so much, Alberto. And the caller from earlier, we love having all the questions answered, as only the Certified Financial Group can. Rodney Ownby and Aaron Bert here taking us through another hour of On the Money. If you want to call in during the break, we got Carrie and Pamela coming up after this break with some more questions. But if you want to join in, 844-580-9326, 844-580 WDBO. You're listening to On the Money, where we're planning tomorrow
Today.
with the Certified Financial.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
Peace of mind that we now have, that's everything to us.
The people that work here are honest and caring, and I feel like I can go to sleep at night.
So schedule your no-obligation visit today at financialgroup.com, where we're planning tomorrow. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them, and they were totally correct how good they are. I had heard from somebody else that it was the best one in town. I've sent several of my teacher friends here.
We're Certified Financial Group, where we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
You know, waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions.
Welcome back to On the Money here on WDBO, brought to you by the Certified Financial Group. So fortunate to be joined by Aaron Bert, and we have Rodney Ownby getting us through another great episode of On the Money. If you want to call in, we have open lines at 844-580-9326, 844-580-WDBO. Let's head to Carrie calling in from Kissimmee. Go ahead, Carrie. You're on the air.
Hi, good morning. Thank you for
Carrie.
taking my call.
Absolutely.
I'm 48 years old. I am currently employed for the last 26 years through my employer, and I have 2 questions.
Sure.
I contribute to a 403B and a 401A to the company. I contribute 12%. The company matches 6%, so for a total of 18%.
Great.
My questions are, what is the difference between those two, and is there a better way to invest?
Got it. What do you think, Rodney?
Typically, the company goes into the 401A, right? And then they would max out. The carry would be maxing out the 403B.
Right. So your 12% carries going into the 403B, and the company's putting the 6% into the 401A.
Oh, okay.
So that's generally how it works. I mean, we've seen lots of, it's normally with nonprofits or hospitals or other types of organizations like that. That's why you have 2 plans. One's to accept the employer contribution. One's to accept the employee contribution. As far as being able to put money in, the max she can put in this year,
$23,500.
It's $23,500. So that's the maximum contribution that you can make. And then obviously your employer is going to just put in that 6% company match. When you reach 50 years old, it jumps up to another 7,500. So that jumps up to 31,000 is the maximum that you can contribute.
Yeah.
Then there's some funky thing now between 60 and 63 that they added, what's called a super catch up. Doesn't apply to you for the next till 15 years from now. It'll probably change between now and then, so I wouldn't pay too much attention to that.
Mm-hmm.
As far as the investments and a better way to invest, the 403B, your company retirement plan by far and away is is the most efficient and effective way to invest for yourself, because that's where you can put the maximum amount of money into a plan. And it's payroll deducted, so it comes right out of your paycheck. You don't see it. It's going right into the plan. And really, your dollar cost averaging, which means that you're buying every pay period into the plan, and you can put away way more money into these types of plans than you can if you were putting money into an IRA or some other sort of instrument outside of your employment. So as far as
tax deferred,
and it's tax, yeah, right. You're getting the tax deduction by putting the money in as well. So as far as, you know, the recommendations to maximize, that's really the best way to maximize your contributions into a retirement plan for yourself, is to use your company plan. However, every company plan offers different investment options. So really it's a matter of looking at what the investment options are within your plan to make sure that it's not just going into cash or, you know, some sort of super conservative investment, because you're probably going to contribute to this plan for the next maybe 15 or 20 years. And so that goes into looking at the investment options that are available and choosing the ones that work best for you. Most companies have target date funds within their plan, so that's an easy kind of set it and forget it type of strategy, where you can pick the target date, the year that's closest to when you plan to retire. So, you know, they may have a 2040 fund or a 2045 fund. You could put all of your dollars in there, and then it's diversified for you and managed for you by that target date fund company. That's one option. Some also offer, you know, risk-based allocations from conservative to aggressive, and, you know, you can choose kind of a risk level, and then it'd be broadly diversified for you as well. The key for you, though, is that you're not changing or trying to jump in and out, that you find a strategy that you like and you kind of stick with it. And that's probably the best way for you to be able to maximize the plan that you have available to you.
Oh, okay. Are there penalties to withdraw from either one of those accounts?
It depends on the situation for which you're withdrawing. So sometimes if you're still working, you generally can't pull money out unless it's for a hardship. Medical, you're going to get evicted. You know, there's IRS approved hardships for pulling money out of a plan, but there usually are penalties. So if you're younger than 59 and a half, you're going to pay a 10% penalty plus ordinary income taxes. So you don't really want to be pulling money out of these plans. This is really meant for retirement for you. Sometimes they do offer what's called loan provisions, so you can borrow money from the plan as well. So there are loan options in some of these plans, but every plan's a little bit different. So, but the loan could be an option for you if you really needed to get your hands on some money. So,
okay, perfect. Thank you so much. I appreciate it.
Absolutely, Carrie. Thank you for the call.
Thanks, Carrie.
Thank you.
Thank you so much, Carrie. If you want to call in, we got the break coming up, but that means give you a chance to call in and talk to me so I can put you in line to talk to the people you really want to talk to. That's Aaron Bert and Rodney Ownby with the Certified Financial Group. Call in right now, 844-580-9326, 844-580-WDBO.
This is
You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, "Hey Lou, I need to, I'm barbecuing this weekend, right? What do you like?" And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers?
Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. This is On the Money, brought to you by the Certified Financial Group. We got two certified financial planners Rodney Ownby and Aaron Bert taking your calls on the air if you want to join the show. And we also have Dave Balakrishnan taking your calls off the air if your calls may be a little more private, or if you want to get straight to the source there inside the four walls of Certified Financial Group. Dave Balakrishnan taking calls off the air at 407-869-9800. That's 407-869-9800. Or you can certainly call in live on the air. Again, we have Aaron Bert and Rodney Ownby taking your calls here on the money. That number is 844-580-9326, 844-580-WDBO. Let's head to Pamela, who's calling from Orlando. Go ahead, Pamela. You're on the air.
Pamela?
Hello?
Hey, how are you, Pamela?
Oh, so sorry. Oh, good. I'm great. Thank you guys. I really appreciate it. So I have a question that I did call in about a few weeks ago, but I'm looking for a little clarification if you can help me. And I did want to make a quick comment that I didn't mention to the caller, but before when you guys were talking, I think to somebody, you were telling them that they thought they were going to work like for, until they were like 70 or whatever it was. And so as far as savings, and I'm in a situation where I ended up getting a health issue in January. I'm 63, and I never, ever expected it, that I had to quit my job.
Oh, wow.
So I ended up having, and no one's been able to diagnose it. So I'm going to go to the Mayo Clinic. I've been to 6 doctors here in Orlando. Anyway, all that to be said, it's pretty crummy. My question is on Social Security, because I had to take it, and I didn't want to do it, but I took it at 63, so I started taking it in May.
Okay.
So I'll have 8 months of it this year, and it's $1,300 a month, and I'm trying to figure out my taxes. So they did explain to me that there are 3 categories. If you make less than 25 on your AGI, there's no Social Security. If you make 25 to 34, you pay 50% tax on that Social Security that you get in a year, right?
Yep.
And then more than 34, you pay 85% of the Social Security, the entire amount. So the entire amount is $10,400. And then figuring out my AGI, that's where I'm a little not sure if I'm getting it right. I took what I made in January, plus I had to take 2 IRA distributions of $7,000 and $8,000, so that's 15. And then I'm getting some dividends on some stock, which is about 500. And these are all included in my AGI, right?
Yeah, well, yes, that's all going to be income to you.
Okay.
Correct. Yep.
And then the other thing is I'm trying to sell my house and move near my daughter, which is in North Florida.
Sure.
And I figure my capital gains, because I know I'm going to sell it for about 400, because I'm just selling it as is, trying to get out. It's worth more, but I just need to move. So 400 minus 250 you can take 250 off because I'm single. And then for my cost basis was 132. So I'm coming up with about 18,000. And so I added those together.
Yep.
Yeah, I added those together, and I'm getting about 37.5 on my AGI. So it looks like I'm going to pay 85%. I'm just asking if I'm getting this right.
Well, you don't pay.
So I take the.
You don't pay 85% tax. That just means that 85% of your Social Security is subject to taxation. So
exactly.
Right. So you made 10 grand. $8,500 is included in your income taxes for 2025. That's what that means.
Okay, can you say that one more time? I made 10.4 on my Social Security.
Right, so 8,500 of that is going to be included, or 85 plus a little bit more is going to be included in your income, and then the other amount is tax-free to you. So even with all of the income that you're saying, you still may not have, a lot of taxes due because of the standard deduction, which is 15 grand. And then now you also have the additional $6,000 deduction. So you're going to have $21,000 of deductions to take off of your AGI and then apply that against your income. Your taxes aren't going to be that high.
Right.
With all of that.
So so when I was telling you all it's included in my AGI, that comes up to 37.5. And then I have to go back. Okay, so this is where I'm getting confused. I'm so sorry. Then I'm going to go back to my Social Security, which is 10,400. Multiply that times 0.85. You said 85% of it is taxed.
Right.
which comes up to 8840.
Right.
That gets added to the AGI.
Yep. Yep.
Okay, so that's 37.5 plus 8840.
Yep. It's like 45, but then you subtract out the deductions that you have and any other credits that you might have, and it starts to come down from there. And so
There's no, yeah.
So you're probably in the 12% tax bracket. So I mean, and this is this is all tax questions. For Social Security taxation, your 85% of your benefit, based off the numbers that you're telling us, is going to be taxable to you. But again, it's just at 85% of your benefit is added to your income, and then all of that is applied against the different tax brackets depending on what other sort of income credits, deductions, so on and so forth.
Yeah.
Yep.
So that comes up to 46,340 is my AGI after adding the Social Security tax, in. And then what's the standard deduction? You said 22,000.
Well, you have 15,000 as this if you're single, right? That's your standard deduction, and then there's the additional $6,000 that was brought in as part of the big beautiful bill, and that's for everybody that's six. What's the age bracket on the?
No, I'm not 65. It's 65 for that.
Yeah, okay.
I don't get that.
Yeah, sorry, you don't get that. You'll get it in a couple of years. So
if I take the 15,000 off, I'm coming up with 31,340.
Right. Okay.
And so you're saying I won't pay tax on that?
No, you will, but you're in the 10%, 12% tax bracket. So if you're going to pay $3,000 to $4,000 in taxes. But some of that's also capital gain. Some of that's also capital gains, which is subject to different rates. So if your income's less,
is it lower?
Well, it's 0% if you're under 48,000. So the capital gains tax on your home could be 0.
Oh.
I mean, there's a lot of different things. There's a lot of different parts moving around here. So, like we say, we're not tax experts, but we know enough to be
right. Exactly.
And so this is and again, none of this is anything that you can really control. Because you already have the income coming in, you already took the things, you're already selling your home, so it's really just planning for how much money you're going to owe come April for tax purposes, and so
that's the point of my call is how much should I be saving?
Yeah,
I'm saving 15% out of every Social Security check and putting it away,
okay,
just in case.
Okay,
really
and then I'm also saving 15%
on your IRA,
kind of what I want. Well, on my IRA, I don't really know about taxes on that. I know that I already saved the tax money for the distributions. I've already done that. I took it out of the check.
Okay.
So I have that saved too.
Okay.
So you withheld those taxes for those?
Well, I personally withheld them. I didn't have them withhold them. I held out 15% of the 7,000 and 15% of the 8,000 distributions that I took from my IRA, sadly.
And you sent that to the IRS?
No, I'm holding it. No, I don't think it's not due until April, right?
Yeah. Well, our system is pay as you go. So as you take those distributions, you probably should pay it so that you don't owe a penalty if you end up owing taxes.
Oh.
So
can I go back and pay it to the IRS?
The IRS can take your money at any time. That is correct. But technically, you're supposed to pay it when you take the distribution. So if you would have taken 7,000, normally you would withhold the 15% at that time.
Well, I've got it with Charles Schwab, and they told me I could do it either way. They could take it out, or I could hold it and pay it in April.
Okay.
So I don't know.
Sure. Well,
I'm sorry. I'm taking too long on you guys, but I feel more clarified on that. I think I'm just going to keep taking 15% out, and just to be safe. And I'm going to have to get a CPA for the first time this year, for this year's taxes, I guess, because it's going to be complicated.
It doesn't sound like it's your situation's overly complicated. Now, if you have the house sale and some other things, you may want to have someone look at your taxes. That might not be a bad idea. 15%, you're probably going to get a refund if you're withholding 15% of all of your income. Plus, the earnings you had at the beginning of the year, you had taxes withheld from that as well. So you're probably in good shape for this year. So you have a good job, Pamela.
For the last 3 years, they've been making me pay in. I never paid in, and I only made probably $38,000 a year. And the last 3 years, I've started to have to pay in. I have no idea why. I mean, it's not a little amount. I mean, it's like $3,000. Well, to me, that's not a little amount. So I don't really know. I mean, nothing's changed. I was at my job for 12 years, and it's really weird.
Well,
I know it's kind of fishy to me, but
well, going forward, it sounds like you're in pretty good shape, and you may end up, if you pay in from the money that you had withheld from the IRA, I think you're going to have plenty of money withheld for tax purposes for 2025, and may even get a refund. And then going forward, if you're having 15% withheld from Social Security, that's pretty straightforward. So, I think you're in good shape, Pam.
yeah.
And if you do get a distribution from the retirement accounts, just have them withhold the taxes. It's just easier that way. If you take distributions from the IRAs.
That's what seems to be happening right now. So, well, thank you guys. You're amazing. I learned so much from you. And over the years, I've been listening for 29 years.
Oh.
I've been in my house 29 years. So, but I'm leaving Orlando, and it's really going to be strange. So I'm moving to Tallahassee. So.
All right. Well, we're on Facebook Live, and we also podcast the show, so you can still listen to us.
Listen up there. Of course.
We appreciate
I will.
Thank you so much.
God bless. Bye-bye.
Good luck with everything.
Take care. Bye-bye. Thanks.
Josh, you there?
I'm here. If you want to join into the conversation, we got an open line for you, 844-580-9326. Aaron, I got a question for you.
Okay, go ahead.
Do you hear comments like that often where people who have been listening to you on the radio for decades even, and then by the time they don't need your services for the good chunk of that time, but maybe they do need it if they don't know they need it.
Right.
But when they need it, they say, "Oh, I got to call Certified Financial Group because I've listened to them for so long that I know I can trust them."
Yeah, we do actually. It's like, it's when you have a pain point and something's uncomfortable, or you just don't know who to turn to, and hopefully we're that familiar voice and that comforting hand that, when the time comes and you're ready to seek professional advice, that we're the people that you want to pick up the phone and talk to. And, our voices are familiar, our name is familiar, our faces are familiar if you're watching us online. And you're just comfortable, coming and talking to us. And that happens all the time. And so that's a great question, Josh. I appreciate you asking.
Oh, I'm thinking about myself. I've heard you guys for so long now, and it's time for me to retire. You know who I'm going to be calling. If you want to join in on the conversation, 844-580-9326, 844-580-WDBO, or write that number down. You might need it in 30 years. You're listening to On the Money, where we're planning today with the Certified Financial.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in, you say, "Hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like?" And Lou goes to, the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, "Veal? Oh, I like veal. Well, what do you got on skirt steak?" "Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic." Lou will never say to you, "Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon?" Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
Here. You then. Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. We got Rodney Ownby and Aaron Bert wrapping up another great hour of the Certified Financial Group's On the Money here on WDBO. Back to you, Aaron.
Yeah, so thanks, Josh. It has been a great show. We've had 4 calls and basically took up all of our airtime here today, so that's a great problem to have. We did want to touch on a couple different things. If you have something that's on your mind, and like we said earlier, you don't want to call into the show, we do have Dave Balakrishnan taking calls off the air at our phone number 407-869-9800. Again, 407-869-9800. So if something comes to you after we're off the air here in 5 minutes, feel free to give him a call. He'll be able to take your questions off the air. I do also want to touch on a couple of our workshops that are coming up. You can find all of these at our website, financialgroup.com. Financialgroup.com. We do have Charles Curry hosting one on 8 October, which I believe is a Wednesday, from 6:30 to 8 o'clock in the evening. That is Social Security planning, basic rules, and claiming strategies. And Charles is also hosting one 18 October on long-term care planning. So that's 18 October, long-term care planning from 10 to 11:30. That's on a Saturday. And on 8 October, Charles is hosting a Social Security web shop in our office from 6:30 to 8 p.m. And finally, Dave Balakrishnan is hosting a tax planning through the 4 stages of retirement workshop, 1 November, also in our office, 10:30 to 11:30. All of these are found on our website, financialgroup.com. That's how you can call or register right there online. We'll send you a confirmation. We'll get you all hooked up. We have not really touched on our topic for the day. I wanted to give Rodney a couple of minutes here as we close out the show to talk about the market commentary for the third quarter and the fourth quarter outlook. Hard to do in 3 minutes, but we're going to do our best here for those people that have been waiting to listen for our market commentary. So give it a go, Rodney.
Yeah, we'll make it quick here. We had all kinds of stuff, but I'll just hit the highlights. We got 2 trading days left, so this isn't finalized for Q3, but if you look at the S&P, so U.S. Large stocks, for the quarter. Q3 up around 6.1, 6.2%. Again, 2 trading days left, so it remains to be seen how it's going to end up. Year to date, the S&P is actually up 13.9%. So with all the tariffs and all the volatility, still good performance in terms of U.S. stocks overall. Q2 GDP was revised upward to 3.8%, driven largely by consumer spending, which has continued to be strong throughout the year, and driving stable performance in the economy. Q3 GDP is expected to come in on trend, but slightly lower due to the lower corporate investment and less capital expenditures. And that trend is expected to continue into Q4 with continuing softness in the economy and reflected in GDP. Q4 GDP is expected to fall well below 2% because of the things we mentioned: lower corporate investment, less capital expenditures, continuing with that trend. And in terms of interest rates, the consensus view is 2 more cuts, 25 basis points, 1 in October and 1 in December. And the only risk to this is if inflation accelerates, or if the recently soft labor market actually picks up and becomes a little bit more robust. Those cuts may be taken off the table.
Yeah, hard to jam in market commentary here in 3 minutes, but basically it looks like everything's being driven basically by interest rates for the most part,
right?
In the anticipation of that, and then tariffs,
right.
and that's obviously having an impact on corporations. So it's hard to predict the future, especially Yogi Berra had some sort of saying that's not coming to me, but there was we get these questions all the time, and what do we think is going to happen to the markets? Where do we think the economy is going to go? And we're pulling out our crystal ball and gazing deep into it and just seeing clouds, which is what most people see when they try to predict the future. But that's part of the planning that we do with our clients day in and day out, is really trying to figure out what sort of risk can our clients afford to take? How much cash should we have sitting in the sidelines? How should the allocations overall be built? So we try to, make sure that we're planning, because we like to say those people who plan don't panic when those eventual market tribulations happen. So anyway, I hear the bumper music, and I really appreciate the show today, Josh. Great show. Good job, Rodney.
Thank you so much. And as we all know, it's tough to make predictions, especially about the future.
Oh, there you go. That's what Yogi Berra.
Yogi Berra.
All right.
Thank you so much. Rodney Ownby here, getting us through the hour alongside Aaron Bert. Dave Balakrishnan taking your calls off the air, 407-869-9800. You've just listened to On the Money, where we're planning today with the Certified Financial Group.